What a day, what a day. This was a great example today of what happens when you forecast the economic data correctly and the markets do something completely other than what you were anticipating anyway. Welcome. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And boy, did we have an explosive day in financial markets today. The ISM service sector survey, very market moving as expected and coming out as expected too, as we expected certainly, and better than the markets anticipated, but the results very different than what one might have surmised in the financial markets. But the event risk does not stop here, because the next piece of this puzzle takes us on a trip to Europe and raises some questions about what may be next for the US dollar, which had a very curious response to today's dynamics that didn't quite square with what's going on. So the question we're going to be asking ourselves now is, what's the euro going to do against the greenback, and will it respond otherwise as the first major European central bank, the one that really everybody's been hanging on, starts to cut rates? Now, of course, the Swiss National Bank has already kicked us off in absolute terms. They've already started cutting, but they only meet 4 times a year, and theirs was a modest move that was not as impactful for broader markets outside of the franc itself. But this ECB announcement, of course, coming on the wake of in the wake of the Bank of Canada cutting earlier today and sending some dovish ripples through the markets, could be quite interesting, especially given the price action that transpired for stocks and more generally in financial markets today. So let's unpack what that was first and get us a bit of stage setting. We were looking for this ISM number. This is the service sector survey from the Institute of Supply Management to come in better than expected, and that it did. So when we talked about this yesterday, we said the expectation is that we are going to come from contraction territory, 49.4. That's below the 50 level that separates growth and contraction in PMI number terms. The expectation was that we're going to return to growth. And what we've been seeing is that U.S. economic data has been, over the past 2 weeks, increasingly improving relative to forecasts, and that has echoed as a little bit of a more troubled view for stocks, because what it's meant is the dilution of Fed rate cut scope for next year. This year has been basically static in the forecast looking at Fed funds futures since mid-April, calling for about a cut and a half. So one cut is fully baked in. It's expected to appear somewhere around November, maybe December. And there's a bit of optionality, something on the order of 50-50, depending on when you look, that there is a second cut. That has been the baseline for basically a month and a half. However, the Fed's posturing around, we don't want to hike, but we're not confident enough to cut, so it's going to be higher for longer as the operating motto here, that has shifted the market's focus to looking at 2025 as the bogey in their Fed policy speculation game. And so the idea was, and we discussed this on the show just yesterday, a mere 24 hours ago, that the PMI number was going to be hotter than expected, and that what this would do is further reduce rate cut expectations for 2025, hurt stocks, and boost the dollar. ISM did come in much better than expected. As we said, there it is, 53, almost 54, 53.8 versus 50.8. a massive surprise in terms of this index. But the internals did not bother the inflation story. Notice the price component, which measures inflation in the service sector, as we discussed at length yesterday, this is, of course, the last bastion of sticky inflation that the Fed is battling before getting to its 2% target. This actually went down a bit. It's still relatively elevated in terms of the pace of growth, but it's come in significantly. And the results were weaker than anticipated. Employment, the place where that inflation mainly comes from, that shrank again. Notice this is a number below 50, meaning employment in the service sector is contracting. And it did so at a slightly faster rate than expected. Now, month to month, the rate actually slowed. 45.9 is faster contraction in employment than 47.1, right? So under 50 is contraction. The further you go under 50, the faster that contraction. So 45.9 is a faster contraction than 47.1. So the pace of shrinking slowed, but we're shrinking nevertheless, and shrinking a little bit faster than expected. All of which dilutes inflation fears, even as business activity booms, 61 versus 53. New orders accelerate, 54 versus 53.2 expected. So the market's got basically the Goldilocks of Goldilocks in this report. They got a robust economic growth story without an inflation scare. Certainly wasn't on my bingo card. And so the results are as you might expect. Stocks roared higher. The expectation was that on the basis of this, a clear and present risk to the market's Fed rate cut expectations has been taken off the table. It's not the only risk. We still have U.S. jobs data coming up on Friday, which is another major part of this story, and we'll talk about that on tomorrow's show. So definitely tune in. We'll go at it in exhaustive detail. But for now, one thing that could have been a meaningful spook to markets clearly did not get the engines going for the bears. The internals of this report were about as encouraging as they could have been. More growth, not more inflation. And so the stock market loved it. On the bond side of things, bonds actually moved higher and yields pulled back, as if signaling that a degree of risk for a hawkish reimagining of the policy outlook has been reduced. But a very curious performance was had from the US dollar. And this is the dollar against the euro. Now, what we find here is indeed very, very curious. Because what we see is that the euro was in a downtrend against the dollar basically all year until it broke out last month. It has since struggled to make hay of it. First, it got stuck against this resistance level here, right above 109, and has since slumped back. It moved higher and actually closed above this high just earlier this week. But then that too failed. And over the course of today, a day when stocks were surging, which is typically bad for the dollar because capital comes out of cash and goes into riskier but ostensibly higher returning assets, yields actually fell because bonds went up in the wake of the ISM data. That should have been negative for the US dollar, but notice the dollar holding its ground here. Even a little bit higher on the day, a touch against the euro. That certainly seems like a meaningful disconnect, which brings us to what is the predominant piece of macro event risk over the next 24 hours. And that is the ECB monetary policy announcement. They too are expected to begin a rate cut cycle, much as the Bank of Canada. Now, this, of course, sets up an interesting perspective. The cut is fully baked in, as we can see here from ESTR futures. This is the Eurozone's equivalent of Fed funds futures. You can see here's where the current deposit rate is. This is the ECB target, 4%. For June, this month, the rate is expected to come into 3.75. There's your cut. You can see that there is another cut that's already there by October. Significant optionality on it arriving in September, but it's fully baked in by October. And then there's some likelihood of a third one. You can see we're approaching 3.25, which would be a full third cut by the end of the year. So we can see here that we have a cut that's there to some extent, but not quite all the way there. So if we look at this then and consider what we're looking at, the overall structure seems to be that we have 67 basis points that's on the menu for this year. So that's 50 basis points in cuts, those two cuts that we saw, that's there, and about 17 basis points on the way to a third, which amounts to a 68% probability that that third cut arrives before year end. This is where this gets interesting. The market already knows this cut is coming. It's fully priced it in right there. So if the ECB cuts, that's not the market moving component. It's in the price. The next question is, are we going to get that second and third cut? Is the likelihood of the third cut going to be higher or lower after this announcement? And that will be what moves the euro and what moves markets in Europe more generally. This is where there is some room for speculation. Eurozone economic data has been getting increasingly strong. You can see that in the PMI data. Of course, there was a recession in the second half of last year in the Eurozone, which is fully on display here with the composite PMI index holding firmly under that 50 line that separates contraction and expansion. It has now returned to expansion and is accelerating that way in the recent data. And what some of that has done is it's given us some stalling and a bit of an uptick in CPI inflation in the Eurozone, things starting to maybe hit a bit of a break on this relentless disinflationary move. So even though we've already shaved away the spike from the war in Ukraine and the initial kind of jolt it gave to energy, we've shaved away the post-COVID jolt to food costs. So it seems like the measures of imported inflation have kind of rebased out of here. So this inflation is now fairly well spread out. We were expecting 2.5 on this last bit, and we got 2.6, which is to say inflation has started to kind of edge up in the wrong direction. From the ECB's perspective, this doesn't necessarily mean that they don't have the room to cut. In fact, they almost certainly are going to do it. But it does mean that the rhetoric might need to change. If the ECB doesn't want to let inflation expectations out of the bag, which would undermine their ability to progress to their target of 2% inflation, then we would need to see perhaps some rhetoric from ECB President Christine Lagarde at the press conference following this announcement and in the actual statement that the Governing Council releases after their decision to suggest, look, don't over extrapolate this cut. We're not on a glide path to a big cutting cycle. Maybe we'll do more. It looks like things are going our way, but don't get all excited. So in other words, a cut that's couched in hawkish rhetoric that reframes market expectations, not toward more cuts, but toward the risk that there's fewer of them after this one. Now, we can see from the makings of the inflation story, this is the past 3 months here, that indeed the ECB does have all the reasons it would need to be cutting. Inflation has weakened in almost every category except energy, where we can see it's recovered a bit because of the prior losses, but consider how little of a factor it is. It's this gray area here, which barely even registers on the chart. So yes, it's recovered after being negative toward the end of last year, in the second half of last year, but this increase here in the past 3 months is negligible. All of the key categories here, that's been a pillar of inflation. Here, that's been a pillar of inflation. All of that has moved lower over the past 3 months. The transport section is negligible. Health is negligible. Education is negligible. They're all very small contributors, as you can see here. The main story still is recreation and culture, to some extent food, and hospitality. Everything else is minor. Here's food. It's come in a lot over the past 3 months. Recreation and culture has come in as well. Hospitality has come in. So the ingredients for the cut are there. Now, if the tone from the ECB isn't a hawkish sort of cut, if the ECB just says, you know what, we're not going to get all bent out of shape about one inflation number. Everything we want to be happening, you can see it in the data. It's happening. Things are going where we need to go. And if the economy is a little bit warmer while we do it, all the better. So get ready, we're in a cutting cycle. If that's the message, well, then the risk for the euro is to head lower. So if the hawkish cut, which by the way, you can see looking at this rate structure, you can see the cut's been here for quite a while, going all the way back to June of March, rather. The June cut, there it is, has been there. So you can see these are the curves from the last 2 ECB meetings, April 11th, March 7th. Both of them saw cuts in June. By April, both of them saw cuts in September, October, and in March, they were deeper cuts. So it's not like we weren't expecting cuts, but there's been a hawkish shift here. So perhaps the kind of hawkish cut strategy is already in the price as well. You can see it here as well. At the beginning of the year, many more cuts expected than now over the course of this year. So maybe the markets have already baked in an ECB that's going to cut, but isn't going to go crazy about it. And if that's the case, then perhaps this reticence from the euro to go down is setting us up for a push this way. The key levels to break here being about 107.50 or so. If you can get under that, you might open up the way all the way down below 106.50 and toward 106. Note, by the way, as this is setting higher highs, RSI, which is this indicator here, the relative strength index, is not doing that. That's negative divergence that might set you up for a decline. If the ECB doesn't do this, and actually comes in full board, delivers the cut, doesn't make it complicated, delivers the concerns about inflation as it cuts, but the markets feel not enough of that has been baked in and does react to the hawkishness, well, then the euro is probably going to break higher this way. But the casualty might be European stocks. You can see here, they've edged up a bit over the past several sessions, having seemingly established a bit of a top. This is the EZU ETF, which tracks the MSCI Eurozone index, a broad index of stocks in the euro area. If the tone from the ECB is in fact something the markets say, oh, hold on, it's a cut, but this rhetoric is hawkish, this is likely to get rejected here and head lower. If, on the other hand, we get full-on dovishness that then punctures the euro, the key question for stocks in the region will be whether this high can get taken out. And if it can, then this index is likely going to mirror what's been happening in the US and head higher. And then, of course, if not, then we set up a situation where the stocks can't rally on good news. And that, of course, is doubly bearish. And that is the story here on Macro Money today. Thanks very much for joining. We're here, of course, Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and what may happen thereafter. Come back and hear what I've got to say to Victor Jones later today. I'll be on the price of truth in just a half hour here with some excellent, tasty programming in between. I'm back on with Chris for Futures Power Hour on Friday, back on with Victor for First Call on Sundays, and writing for the News and Insights portion of tastylive.com. I'm also opining sporadically on the platform formerly known as Twitter, @IliasBback. Thanks very much for joining. See you in a bit.